Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about the whole financial sector, a sector for which a lot of queries have come in from my subscribers and viewers. So I'm taking all that together in this presentation as to why I do not like the financial sector as a whole, and what are the intricacies of it and the issues related to it. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Now, about this sector, the financial sector comprises of the banks like the PNB, the HDFC Bank, the ICICI Bank, etc. The NBFCs, which are the non-banking financial companies such as Bajaj Finance or Reliance Capital or other, you could say, insurance firms as well. But I'll take this liberty to tell you that I'm not talking of the insurance companies, which are pretty good to invest in. But these are only lending firms, non-banking financial firms. And then there are microfinance companies like the Ujjivans of the world, or of that type. So one needs to understand that the sector that I'm talking about, the financial sector, in that these are the three aspects of the financial sector that I would like to talk about, and the risk associated in these sectors I'll talk about in this presentation. It currently has the highest combined market cap. So if you look at the whole market cap of the uh, BSC and NSC, the NBFCs, MFCs, and banks combined would certainly have the highest market cap. Uh, the stocks are basically in the large caps. As mega caps, you have the HDFC Bank, uh, etc. up there, like you could say Axis Bank, HDFC Bank. uh, then there is also Bajaj Finance, which has become more or less a large cap. Then there are companies in the mid cap arena as well, which are the PSU banks, which have been beaten down to pulp, have become mid caps. And there are small cap microfinance companies as well as small cap banks, which are right now trading in the stock market. Uh, they do really well in strong economies. So when we had bull run in 2003 to 7, everybody talks of infrastructure, capital goods doing well, and you can say roads, construction, cement. But they forget that banks did exceptionally well, such as HDFC Bank or the ICICI Bank likes. So banks really do well because they have a business of lending to these sectors. So they really do well in a very good economies. And marquee stocks in India are Bajaj Finance and the HDFC Bank, HDFC, the HDFC twins as we call it. They are the biggest brands or the advertisement for the financial sector. So why people love it? Well, it can make a lot of money if pegged well. So if somebody would have bought HDFC Bank say 10 years ago, even 10 years ago it looked expensive, they would have made something like 12, 15 times of the money. The way it has risen over the years. Similar with Bajaj Finance, if somebody would have picked it up around 2015-16, over the last 4 years, it has I think become 8x or 9x in that period. But then again, apart from these two companies, there have been the fallout of the ICICI Bank, there have been the fallout of the Yes Bank, and we have seen how private sector banks have also catapulted to 52-week lows and going deeper down into the mires rather than going up. So it's not a sectoral bet, and that is where the risk is, and I'll talk about it in the next slide. They are big compounders over years, as I have mentioned with these two examples. But again, these are probably a few examples in it. Uh, of course, banks will not go out of fashion. So it is not that banks will stop working, or good banks, private sector banks, or MDFCs would go out of work. They would always be there. So they'll not go burst very easily, although some banks do, but they'll not go burst very easily. and that's why people like to invest in them, that they'll keep on compounding money through interest, etc. They are fast movers, they are high beta. Whenever the markets move up, banks go up very quickly and sharply rather than other sectors, and that's why people love it. Most of the traders love it, and there's high volume in all NBFCs and banks compared to other sectors. Why I never liked it, and there are a lot of you can say negatives attached with banking firms or NBFCs. First of all, economic growth has to be robust for these NBFCs to really do well over a period of time. It is not that HDFC Bank will keep on compounding and their profits or its profits by 18-20% if the economy really slows down to say 3% or 3.5% in the coming years. It would suffer, and we have seen that even HDFC Bank has produced numbers with a higher NPA for the first time in I think 20-25 quarters. So one needs to understand that economy is directly related to the banking sector, and we have seen what has happened with the PMC Bank. If, for instance, everybody is talking about PMC Bank and the way it has gone bust. For instance, they had lended money to HDIL, and if HDIL would have done really well, they would have made loads of money, and this issue would not have come up. And this is the risk attached with banks or NBFCs, that lending is a very good business if you do it in the right way, and once it is done badly, then you could go burst very easily and you could be in trouble very quickly. So economic growth is essential. Interest, as I said, is a double-edged sword. When you such as Bajaj Finance gives interest to common individuals, and that's why the company is doing really well, because salary payers pay out their debts very easily. But what if their jobs go out, or the scenario becomes even worse on the economic front, and India do not grow or grow by 2.5%, and the people do not have jobs or the surety of a job, then even Bajaj Finance will suffer, HDFC Bank will suffer. And we have seen that banks which have lended over a period of time and have, you could say, leveraged their balance sheet, and their balance sheet is fractured, we have seen their stocks go really I mean, they have been smashed, such as Yes Bank, which have produced a very bad numbers this time around, and things of corporate governance have come out in that company. So one has to be really careful, and this is my third point, that it is very hard to understand and project. Yes, you can project. For instance, 2 years back, Yes Bank was darling of the market, and everybody was talking of that being the next HDFC Bank, and it will do really well. Similar with RBL Bank, which have been backed up by Ramdev Agarwal ji. Nothing against him, but marquee players have backed the stock, the company, and people have loaded up on RBL Bank. Now it is at around 250 to 60 rupees from 600 650. So one needs to be very careful in this sector. Unless you understand the sector inside out, do not go ahead and invest it. That is my suggestion. It is very easy to cook books and have frauds in the company. We have seen what has happened with lending in ICICI Bank with Chandra Kochar. We have seen what is happening with Yes Bank. We have seen what has happened with RBL Bank, etc. That lending is easily, but taking out money or bringing back that money is extremely difficult. So, as I mentioned, it is very hard to understand the sector itself or the banks. And even if you're very sure about the corporate governance and the company, we have seen what has happened with Yes Bank and RBL. Numbers may not be precise, and commentary is relative. Why I've written this separately is that the numbers may come out and the company is growing with 20% interest growth, NIIs, and etc., and so on and so forth. The profitability has grown by 18-20%, and suddenly after 2 weeks on a weekend, you come to know that the numbers were not that good, and it has been cooked up, and there have been a greater NPA than the NPA that have been mentioned. The GNPA might be higher. There could be a lot that would be written in the annual report rather than what has been said during the results press conference, and etc., etc. They might not have done any fraud, the bank might not have done fraud, but uh, a lot of nitty gritties might have been changed. There could have been intricacies with the complications with the kind of numbers that have been put up, and the accounting standards that have been maintained, and so on and so forth. So when you are investing in a company which is more into a lending business, which is more interest related, then interest cost might be projected differently on the books, and that's why people who have very good accounting background or RCA are very good at investing in such companies, rather than normal people who are more engineers, doctors, and invest for their retirement, etc. And that's why I say that we as a whole, people who do not understand the books of financial companies should invest in cash businesses such as Britannia, Asian Paints, HUL, Nestle, and the likes. NPA value is more subjective than numeric. So you can have an NPA of 4.9% for Bank A in the September quarter, and in December quarter it could have a lower NPA, but then the GNPA would have increased, or the lower in NPA would have been relatively higher than compared to the lower NPA that has been projected by other banks, and so on and so forth. So there are a number of you could say number of things that you have to look at, rather than just one or two things, rather than just the profits or the sales of the company. There is a lot of things that goes on in a banking balance sheet. And I believe that HDFC Bank and Bajaj Finance are exceptions in a sector which has never produced money for the retailers. That's what I believe. For instance, if you would have invested in SBI 10 years ago, or a PNB for that instance, thinking that they are one of the largest banks in India, and probably the largest public sector banks of India, and so on and so forth, you would hardly have made money. I have not checked the charts or anything. Probably you have lost a lot of money in PNB and hardly have made money in SBI, excluding the dividends. Now you see, like housing finance companies. I have not written about housing finance here, but microfinance and housing finance companies also. Just a few names that come to mind are DHFL. Now, DHFL have slumped to I don't know what levels at the moment, double digit levels and all that, from being a marquee Nifty 500 stock. It is right there in the dumps. So why? Because they have lended a lot, and now they are not able to recover money. Now the housing finance company will always struggle in a difficult market, but the consumer companies will either do very well in a very good economy, or do well in a difficult economy. And that's why I always press the need to buy into consumer companies, into consumer durables, etc., because they would do well, and they would keep you safe in difficult times, and they'll make you big money when the times are really good. And so even the housing finance companies are under stress at the moment, and these NPAs keep changing, and once housing finance companies do not do well, the banks itself would not do well, which lend to these companies as well. So all this is a net in itself, a web in itself, and one needs to understand that. If you do not understand all of this, that to which companies, for instance, something like HDIL, if people had not understood about HDIL taking loans from one bank, or taking loans on what level from that bank, and etc., they and that was the reason that they lost money in that company at the moment. And look at where HDIL is, and look at where the bank which has lended to such a company is, the PMC bank, and similar with other listed banks as well. So one needs to be very careful and more understanding of the situation when you invest in banks or NBFCs. So my call at the moment is that invest if you have a complete understanding of the bank or the NBFC or the sector itself, and buy. For if you ask me, and this is just my call, and you should just consult with your financial advisor. But my call is that buy more simpler business, which are more cash generating, which sells goods and gets cash back immediately, do not have interest at all, do not have loans, do not have debt at all. And when you look at financial companies, they are sitting on a lot of debt, and that's the business, that's the name of the game in the banking financial sector. But here, if you look at something like Britannia, Asian Paints, HUL, Aisha Motors, Page Industry, etc., in these kind of businesses, it's just that you're selling bikes, paints, FMCG products, and you're getting cash back, and probably you're going to make 7 8%, sometime even 20%, sometime 3%, but you're going to make some money. And there's very less chance of you cooking up books of any fraud or any of that sort. In I'm talking of the larger FMCG firms. And your money would be more safe in such stocks rather than in banking. Yes, it might not grow that sharply quickly, but over a period of 8 10 years it will grow better than I believe in banking companies, because it is very hard to find that HDFC Bank or that Bajaj Finance easily. So be alert on buying financials, and immediately exit when you hear anything remotely negative about the company. And only put 5% of your total investment. I tell that to everyone who invest in any company, be it financials, be it consumers or anything, so that if you lose all of it, then still you'll have 95% of your portfolio intact. So this was my video on the financial sector itself, whether it's India Bulls Housing Finance or HDFC Bank or ICICI or what has happened in Yes Bank. Maybe I have answered all your queries. Please share, and comment on the videos that I post, and please subscribe to my channel. Thanks a lot for watching.